Good afternoon, everyone. Good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and we're delighted to have so many friends with us in person, as well as untold millions on the web watching our semi-annual Global Economic Prospects event. I'd like to just say a word about the nature of these events before turning it over to Dave Stockton, Nick Lardy, and Jose De Gregorio for the substance. Long ago, Fred Bergston, with a little encouragement from me, started this series with Mike Musa, and then I had the privilege to restart it 5 years ago with Dave Stockton, and more about that later. The idea of this series is to not so much critique the official forecasts. Our colleagues at the IMF and the OECD, among other places, have vast staffs, vast data, and forecasting models that we do not have. But our idea is that being not part of the official sector and having depth of expertise on various critical economies, as well as on how policy gets made, that we could, with this series, highlight specific themes or specific regions where we feel something different from the consensus. And the backbone of these events is the initial forecast done by Dave on the US, but also bringing together from our various country experts, be it Nick on China, myself on Japan, Marcus Noland on South Korea, Jacob Kierkegaard on the EU, and so on. A basic statement about where the consensus forecast is probably, or where the likely WEO forecast, not that we have any inside information, of course, where the likely WEO forecast is a little different from what we think. And so every time we bring before you three of our scholars to highlight those points of difference and just raise it. And just to crow a little bit about our team, we had, I guess now almost 3 years ago, Monica de Bola come out and warn people that things were going south, if you'll excuse the expression, in Brazil much faster and much more much longer duration than people were recognizing. And she, of course, got that call right, sadly. Monica, by the way, has her Portuguese language bestseller in Brazil on Brazilian economy. Has just been nominated for a major award, the Djibouti Award in Brazil. We had Jacob Kierkegaard, who I already mentioned, and others of us, myself included, coming forward and telling you, no, the EU is primed for much more expansion, is less fragile than many of you think, and that, again, has been borne out over the last couple of years in expansion. We had Nick Lardy come forward in 2015 and 2016 and remind people that financial fragility in China might have been overrated, and the floor under Chinese growth was both higher and more solid than many people thought, and I and others also came in and said the exchange rate crisis was overdone. That also has been borne out. We've, of course, gotten some things wrong as well, which I will not bother to mention. But in the last year and a half, we focused more than we usually do on the US, because, of course, that has been the source of great variation. And I made the call a year ago, almost to the day, that if Trump won, there would be a Republican majority in both houses, that the agenda would be driven through deregulation, and that there would be large fiscal cuts. And that was not the consensus view September 30th. And that has gotten right, except for like everyone else, but me getting wrong the timing on the fiscal cuts. Who knew it would take so long to write a budget? Anyway, this is advertising more just to remind you to take in that spirit what we're doing here. We're trying to identify big calls, directional calls, somewhat magnitude. We're not fighting with the WEO or the OECD over tenths of a point on GDP. We're just trying to identify places where we think, for whatever reason, the consensus is missing something, and be consistent across our semi-annual presentations. So today, in that spirit, we have three excellent presentations. First, David Stockton, who, of course, is a senior fellow here at the Institute, and also, I want to make sure I say the name of the company right, chief economist at Monetary Policy Analytics. Dave, of course, oversaw the Board of Governors' financial market and macroeconomic forecasts from 2000 to 2011 as head of the Division of Research and Statistics at the Fed. And we follow that with Nicholas Lardy, our and everybody's best American expert on China, who is, of course, the Anthony M. Solomon Senior Fellow here at the Peterson Institute and has been with us here since 2003. Finally, we have as a special guest appearance, he honors us with occasionally, our non-resident Senior Fellow, Dr. Jose de Gregorio, or I should say Professor Jose de Gregorio, who teaches at the Department of Economics at the University of Chile, but of course was I keep saying of course because these are people who should not need introduction, who was of course the governor of the Central Bank of Chile from 2007 to 2011, and prior to that, vice governor and a member of the board. Dave will take us through the broad economic outlook, drawing on all our people and the particular aspects that he wants to emphasize on the inflation uncertainties in the US. Nick will take us through his not driven to be contrarian, but ends up contrarian views on financial stability and long-term growth in China. And Jose will be telling us, picking up on things he has said at this podium in the past, why the long-term productivity growth aspects in Latin America are affecting the short-term outlook as well. So let me turn it over to Dave. After the three presentations, we will take, of course, questions from our audience. Dave.
Thank you, Adam. I guess I can say for the first time in the 5 years that I've been doing this, it sort of feels like the global economy is something close to a synchronous upturn in activity, of a synchronous expansion. It's not uniform across the globe, but it's far enough and widespread enough that I think we can now say, we were calling it gaining momentum in the spring. I think now we would say that the global economy appears to be sustaining that momentum. So what are the main drivers? Obviously, it depends a lot on each individual economy. But it's the case that, at least for the advanced economies, that accommodative monetary policies with accompanying supportive financial conditions are providing some boost to overall activity. We've gone from a situation in which fiscal policies in many countries were restrictive and now are at least neutral, or in some cases mildly stimulative. It's amazing looking across both advanced and developing economies at surveys of businesses, purchasing managers, households. There does seem to be some improvement in the animal spirits. Confidence has increased in many places as well. That's providing some support to activity. And then finally, we have a number of major commodity exporters that were in deep recession that now appear to be beginning to climb out of those recessions and actually move into modest expansion. While some commodity importers are still benefiting significantly from the decline in prices. As you can see, I'm expecting activity to run around 3.75% for global output this year. I think we can sustain that pace of activity next year as well. I won't go into all the details of each individual country. I would point out the Euro area is one area where we have been more bullish than the consensus in recent years, and I think both the data and the consensus are moving in our direction. I think Europe is looking like it's on a more solid course currently than has been the case in the past. On the United Kingdom, I guess I'm more pessimistic than the consensus forecast currently for the UK. I do think they're looking at a substantial period of prolonged uncertainty, policy uncertainty, that is likely to weigh, especially on business spending, but also a household sector that looks fairly stretched at this point. So I'm expecting some slowdown in activity there. Nick will talk more about China, but suffice it to say that we continue to see growth in China expanding in the mid-sixes over the course of the next couple of years as well. And then finally, as I just noted, in both Brazil and Russia that had experienced deep downturns, things are now looking like they've turned up, and those expansions have a bit more traction than they had previously. For the United States, the story is pretty simple. We have been experiencing a period of above trend growth. I think that is going to continue over the course of the next 2 years, with growth running roughly 2.25%, and then eventually slowing in the face of less accommodative monetary policy. That growth is sufficient to put continued downward pressure on the unemployment rate, which I see dropping below 4% over the course of the next couple of years. And then I'm also anticipating some pickup in the pace of inflation back towards the 2% target. Now, I'd quickly, on that last point you to the confidence intervals around those forecasts, and especially the one around inflation. Those are not merely decorative. They actually illustrate just how humble we need to be about these forecasts. Those are big, wide confidence intervals, and they're based on actual forecast errors. Actually based on the forecast errors of the Fed staff, since I participated in making most of those errors over the course of the 10 years that Adam noted. So I think they're probably reasonably representative of the uncertainty surrounding this forecast as well. Obviously, in thinking about the U.S. economy, one of the major sources of uncertainty that we're currently are confronting is what's going to happen with fiscal policy. And I can tell you right now, I don't know. I don't think anybody else does either. But what I've incorporated into this forecast is an expectation that we will get a substantial cut in taxes, and we'll get some increase in defense and non-defense spending. These are very similar to the policies that I had incorporated into the spring forecast. That tax cut runs roughly $1.2 trillion over 10 years. That's a little bit less than the $1.5 trillion that the Senate Republican Budget Committee is talking about currently, but it's certainly in that kind of ballpark. And my expectation is there's going to be significant desire to increase defense spending, and that won't be offset by cuts in non-defense spending, but in order to buy that increase in defense spending, there's going to be an increase in non-defense spending as well. So it's reasonable to ask, given all the uncertainties, what would my forecast look like if, in fact, this all just falls through? So it's possible that Adam was a bit premature in declaring his victory and forecasting a substantial fiscal stimulus. It's possible, as we saw with healthcare, it could all just fall apart at some point. So this is what my forecast would look like eliminating the fiscal stimulus. Obviously, that reduces growth some, raises the path for the unemployment rate, and has very little effect on inflation. This is based on a model simulation of FRB-US. We turn on the Taylor rule because we'd assume monetary policy would react to that weaker path for output and a higher unemployment rate. Funds rate path is roughly 50 basis points lower in that simulation than it would be in my baseline forecast. It's not a dramatically different forecast, but it's a little softer landing than the one with the fiscal stimulus at this point, a little less of an overshoot. In thinking about the components of private demand, I think we see some cross currents. It's the case that consumer spending has been the key factor in supporting this expansion. But now the expansion is beginning to show some of its age. I think we're seeing that in a slowdown in consumer durable spending. You see that most notably in the case of motor vehicles, but you see it in the form of other consumer durables as well. But that's offset by some considerable support to activity as well, coming from, one case, a substantial increase in the ratio of household net worth to disposable income. Households have had significant increases on the asset side of their balance sheet, coming from the rise in the stock market and from the increase in house prices. And that is likely to provide, that wealth effect will provide some support to consumption, in addition to the fact that we have ongoing employment gains that are helping support things. In the housing sector, we're just continuing to grind higher, slowly grind higher. Some of the more recent high-frequency indicators have been a little bit softer on housing starts and housing demand. I think that probably overstates some of the recent weakness, and I would caution you in the months ahead, we're going to see a significant increase there as rebuilding activity takes place in Texas and in Florida. That will overstate the strength, and you will need to take that into account as well. But for the most part, the fundamentals still look pretty good for housing, and I think we're seeing that in terms of the increase in construction, and good enough to sustain house price increases of roughly 5%, which is more than the growth rate of rents, more than the growth rate of disposable income, so that sort of house valuations are starting once again to look a little bit more rich than they had previously. One of the more encouraging developments over the past year in terms of the U.S. economy has been a step up in the pace of business fixed investment. As you can see on the left, new orders for capital equipment have really been on a pretty steady uptrend of late, and the shipments as well. And we've seen that translated into a step up in the growth rate of business fixed investment, which had been quite weak the preceding 2 years and looks on a pace to increase about 6% this year, with all of the major components of investment spending showing improvement as well. And I think over the following 2 years, we're likely to continue to see some increase there. Now, what's driving that is a little hard to tell, because investment spending had been so much weaker than fundamentals. This just could be investment spending getting back on track with the fundamentals. But I don't think one can discount the fact that business expectations, both for a reduction in corporate income tax rates and what they perceive to be as a more favorable regulatory environment, could be driving investment spending as well at this point. We've been getting more support from the external sector. So in addition to the fact that global activity has picked up, and that's been helping boost demand for U.S. exports, the recent softening of the dollar also has been shifting global demand away from foreign producers and towards U.S. producers. And as you can see, from 2014 to 2016, we were getting a subtraction of GDP growth of about 0.5 percentage point from net exports. This year, it looks to be roughly flat, and I would expect just a very modest subtraction of growth the following 2 years, of roughly a little less than 0.25 percentage point. So that's also been adding upward impetus to activity at this point. Overall, obviously, GDP growth, as I noted earlier, running well above trend, and we see that reflected in the labor market as well, where we've been generating payroll gains of roughly 175,000 per month on average thus far this year. And that's well above, is that shaded area shown on the left there, is 80 to 100,000 is what we roughly estimate would be required in terms of payroll growth to stabilize the unemployment rate. So with payroll gains significantly above that, we've been seeing some decline, as you can see on the right-hand side, in the unemployment rate. I showed this graph a couple of years ago at a time when it was the case that it looked like the official unemployment rate was overstating the improvement in the labor market, and the extended unemployment rate that includes marginal workers, part-time workers, and so forth was out of line with that. Now they both improved. Things are looking better across most measures. But it's still the case that we're still not certain exactly how tight labor markets are. And this is one illustration of some of the difficulties one has in making those kinds of judgments. If you look at the left-hand side, job openings are at an exceedingly high level. It looks like there's a lot of vacancy, a lot of positions firms are not able to fill currently, and much higher than they were prior to the crisis. But if you look at the right-hand side, the intensity with which firms are working to fill those empty positions has improved, to be sure, but hasn't gotten back to pre-crisis levels. So there still are a lot of job openings businesses are posting, but they're not necessarily working as hard as they used to fill those positions. And that's, I think, provides a sense that it is still the case that there are some margins here in the labor market that probably are not completely back to normal. That said, it's clear that we're looking at something that is still approaching. It may be hot as a bit of a stretch, but certainly a very warm labor market. You can see if those of you who have attended these meetings in recent years know that we've been arguing for quite some time that the Fed could take a chance by pushing the economy a bit harder, that there might, in fact, be benefits that would follow from running a hot labor market. And in fact, I think we're seeing those benefits now. You see part-time, people who were working part-time for economic reasons, that is people who wanted to work more hours but couldn't because they were constrained by their employer. That's declined back now to sort of historical averages. That's looking much better than it had been previously. And then I think labor force participation rates, another factor as well. You know, just think back a couple of years ago, the debate was any of the decline in labor force participation cyclical? There was work done at the Federal Reserve that suggested all of the decline could be explained by demographic factors. Well, what we see now for several years is the labor force participation rate in the context of a tightening labor market moving sideways despite what we know are very substantial downward pressures associated with evolving demographics. So we're getting the kinds of benefits that I think many of us expected, and I think in some sense Janet Yellen was willing to take a chance with in terms of guiding the committee to produce an economy that was operating relatively hot at this point. Now, you might say, geez, no wage inflation. How can this be a hot labor market? Well, I actually think that's a bit of a mischaracterization of the data. Here you see three different measures of hourly labor compensation: the employment cost index, average hourly earnings, and a measure put together by the Atlanta Fed that measures median wage changes from the current population survey. All of those measures are running a little bit higher than they were, either a little bit or considerably higher than they were the preceding 5 years, in the past year and a half, running faster. So I think we are seeing some modest upward pressures on wages associated with the fact that the labor market has gotten heated up some. And I'm expecting that process to continue, again, in a fairly slow fashion. The same can't be said on the price front. I mean, I think it's a much murkier picture there. So as you can see, the core CPI had moved up some over the course of the preceding few years. This year has backed off noticeably. Now, we know there were some one-time factors that were helping pull that index down, a big decline in wireless communications prices and a few other things as well. But if you take out outliers using something like the median CPI that doesn't just eliminate food and energy, but it eliminates any price that has moved significantly higher or lower, you see there's been some downward movement there as well. Not as pronounced as in the measured core CPI. But that's not the whole story. There is another measure produced by the New York Federal Reserve staff. Their argument is, why, if you're going to try to figure out what underlying trend in inflation is, why would you take things away from the index? Why not add things to the index? So they use a dynamic factor model that basically has a huge data set of prices, but also has measures, survey measures. It has some financial market information, some real activity variables. And they show that measure has a pretty good job of forecasting inflation. It's gone just the opposite direction. It's moved up. Now, I would take that with a grain of salt. I had plenty of, in my years of being research director, plenty of eager young economists come to my office saying they've got this brand new model and it does better than anything else. And for 6 months, maybe it did, and then beyond that, maybe not so much. So I'm not necessarily showing this to claim that, in fact, we know inflation's moved up, not down. I'm just saying these are the kinds of considerations the Fed is looking at and thinking about policy going forward. Another thing they're looking at, obviously, is inflation expectations. And I think this really is an important factor because any downward movement in inflation expectations that was going to be sustained could, in fact, make it that much more difficult for the Fed to get back to this 2% target. And here, too, I think the data are a little bit ambiguous. Surveys of professional forecasters have been basically rock solid, haven't changed at all. A measure using TIPS measures, using a five-year forwards, to estimate inflation expectations came down in 2015 and 16, has moved up some this year and then moved back down with the price data as well. Probably looks like, I guess I'd be worried that might be moving down some, but again, even that is not necessarily absolutely clear. So there we go. So my forecast is very similar to the one produced by the Fed currently. I am expecting, in the context of an economy with an unemployment rate dropping below 4% and growth remaining above trend, that we will see some gradual upward movement in inflation. Now, having done economic forecasting for a long time, I know it's going to be written on my tombstone. The lines were always smooth on the right-hand side of the charts. And it's whenever we show our forecast, it all looks like it's just everything. Well, in fact, what it's going to look like is more like the left-hand side of the chart. It's going to be really noisy. And I mention that because I think this whole issue about whether or not inflation is picking up, slowing down, is not going to be resolved in a year's time or 2 years' time. It's only going to be resolved after a long period of time and looking back. And I would encourage you to think of my forecast not so much as this point forecast that I'm showing you, but as a probabilistic statement that I think it's more likely that inflation will edge up over the course of the next few years than edge down. And beyond that, thinking back to those confidence intervals, I don't think we can say a whole lot more than that at this point. Now, the Fed is looking at that exact same picture, and I think they also, to date at least, have been willing to look through this recent slowdown in inflation, and I think they're still on track for a gradual removal of accommodation, a gradual increase in the federal funds rate. And of course, as you probably know, they announced last month that they would be beginning to reduce their portfolio. I think that is likely to add a little bit more to withdrawal of accommodation. So monetary policy is going to be a little less supportive going forward. And that explains why it is, I think, in fact, we'll get some slowing in activity back to trend. The Fed faces some significant challenges here ahead. One is they've got to guide inflation back to 2% over some reasonable period of time. That's not obviously going to be an easy thing to do. And it by itself would suggest a cautious approach to removing that accommodation. But there's two things that work in the other direction. One is, I think they're genuinely worried about the pace with which the unemployment rate is falling. I think Janet Yellen and her colleagues were mostly happy to have the labor market tighten, have the unemployment rate go down. But I think they are justifiably concerned about just how fast and how far that can go. They're also expressing more concern recently about the potential for the current rate environment, if sustained, to create some kind of financial imbalances that they'll have to deal with down the road. And I think that concern is justified as well. Whatever you thought about equity valuations a year ago, you can say this for sure, they're richer now than they were a year ago. And as I noted earlier, house prices continuing to outstrip incomes and outstrip rents. Gee, that's a lot like we were seeing back in the mid-2000s. We're not there yet. None of these things look that far out of whack, but they certainly are some reason for concern. There's going to be a considerable change of leadership at the Federal Reserve. Even if Janet Yellen is reappointed, we're going to have two new vice chairs. We got one of those vice chairs today, where Andy Quarles was confirmed for his position. And then considerable turnover at the board itself. We're losing a lot of experience, and it's not quite clear. I think it's fair to say with this administration, waking up every day and reading the newspapers, somebody else has moved to the top of the list, somebody else has moved down, somebody's moved up. It's really hard to know exactly where we're going to be a year from now. But if I had a guess, I'd say the risks are that we will see policy tilt to an easier direction rather than a tighter direction. And that won't be because somebody's appointed that's a political hack and just wants to generate growth to help the president. It will be because they appoint people who have a natural sympathy to the notion that the economy can grow 3%, when, if I'm right, the economy might not be able to grow much faster than 2% over the longer haul. And that is going to lead to policy decisions that lean in the direction of allowing growth to go on longer, to allow the unemployment rate to fall further. And with a flat Phillips curve, the problems generated by that particular policy strategy occur down the road, maybe further down the road than anybody would be concerned about. So I'm going to stop there, turn it over to Nick.
Well, before I get into discussing what I think the current issues are in China, I am going to spend a little time reviewing a couple things that Adam talked about, some of my previous discussions. As you know, if you've been coming to these for a few years, I don't generally talk about what the forecast is. I'm not a forecaster. I certainly would have talked with Dave about this mid-6. I think that's quite reasonable. I've tended to focus on dispelling what I think are misunderstandings about the Chinese economy, and you can agree or disagree, but it might affect your view on the outlook. So I want to go through a couple of examples. One, I think Adam alluded to, in the summer of 2015, there was a gigantic meltdown of the stock market in Shanghai and Shenzhen, a lot of depression of stock prices globally, and a lot of commentators thought this sell-off was a prelude to a sharp decline in Chinese growth. And I argued in the New York Times in an op-ed in August and shortly thereafter at the fall meeting of 2015 that this was a sell-off that was overdue. The market had risen 150% in the 1 year to the peak in June of 2015. I argued that since equity was a very small share of household wealth, that there would not be a negative impact on consumption, and so I didn't think there were going to be any macroeconomic consequences of this big sell-off. And when the numbers came in, the contribution of consumption growth to GDP in 2015 were higher than they had been in 2014. We were at 4.2 percentage points as opposed to 3.6 percentage points in the previous years. The second example was the currency issue that Adam mentioned. There was a seeming sharp move in the currency in August of 2015. The Chinese central bank moved the currency lower and introduced a new mechanism for managing the exchange rate. And again, this was still in the period where people were very negative on Chinese economic growth. They thought this was the beginning of a substantial devaluation of the currency by the authorities to boost economic growth. And I argued that in this blog that we posted that the move was really in response to the IMF call for a more flexible exchange rate, and China was doing this to improve its chances of having the RMB included in the SDR basket, and that's exactly what happened. A few months later, the IMF did approve the inclusion of the RMB in the basket, and there was no big depreciation of the Chinese currency. The last one I'll mention is in early 2016, when Kyle Bass was beating the drums about a coming currency crisis in China, saying that not only had reserves fallen by $500 billion in the course of 2015, they were very substantially overstated. And in the April meeting here, I said, well, his analysis was wrong and his facts were wrong. That the decline in reserves, about 1/3 of it was due to the appreciation of the dollar, which reduced the value of China's foreign currency holdings denominated in euros, sterling, and yen. Another 40% was Chinese corporates paying down their debt. Another big chunk was foreigners unwinding carry trades. There wasn't really much evidence that the Chinese population had lost confidence in the economy or had lost confidence in the currency, and I argued basically all these flows were self-limiting. So I didn't think the decline in reserves was so adverse. I was predicting that the level of reserves would stabilize and that massive currency depreciation was very, very unlikely. Again, it all came true. Within a few months, reserves had stabilized at about $3 trillion, which is basically the level they've been at now for quite some time. So today I want to talk about the new main concern a lot of people have. Certainly the IMF, Standard & Poor's, Moody's are all talking about the huge increase in credit to GDP, debt to GDP by the non-financial sector. This is corporates and households, not government. You can see the very steep run-up in this metric through the current time. And the IMF is now projecting that credit growth will continue to be very, very rapid going forward and will be at something close to 300% of GDP credit to GDP ratio shortly after 2020. And they point out that internationally, this kind of sharp move up has been associated with a growth slowdown, and often financial crises. So they say financial risks are rising and could eventually lead to what the fund calls a sharp adjustment, which I think is a euphemism for pretty the pretty sharp decline in the growth of output. So my view is somewhat different. They do acknowledge, the fund acknowledges that credit growth has slowed and moderated a bit in recent quarters, but they think the leadership is determined to double GDP in the decade between 2010 and 2020, a long-announced goal. They think the slowdown in credit that has occurred to date will lead to a slowdown in economic growth, and in order to get the GDP to double, that they will reaccelerate growth of credit, which is reflected in this diagram. So last month, a few weeks ago in the FT, I put forward an alternative point of view. I made 3 points. First, I think China's leadership over the last year has substantially increased the priority that they're giving to controlling financial risk and reducing leverage. Second, I argue that this priority has emboldened the regulators to crack down on practices that contributed to increased financial risk in recent years, and also leading to a slowdown in the growth of credit and an increase in the share of credit that's being intermediated through better regulated channels. And third, I argued that a resumption of very high credit growth was not necessarily in the cards. China can double its GDP over this period that I just mentioned, with growth about a half a percentage point below what they've had in recent years, so they don't necessarily need to reaccelerate credit growth if they slow down to something closer to 6%. Well, let me expand on some of these points. The first one about the priority. Here are 3 major speeches that Xi Jinping, the chairman of the Communist Party, has given addressing risk and leverage. If you follow the Western press, you would have the impression that Xi has been solely concerned with his ongoing anti-corruption campaign, consolidating his political power in the run-up to the 19th Party Congress, which begins in less than 2 weeks. As I say, in reality, he's given 5 major speeches on these topics, beginning in December at the Economic Work Conference, and most recently in July at the Financial Work Conference, which is a once every 5 years event. And I just have a few phrases from his speech. I'm not going to read these. I just would suggest, if you read it, you might think that Janet Yellen has a sideline business as a ghostwriter for the chairman of the Chinese Communist Party. They also, at the Financial Work Conference, set up a new committee to coordinate across the various regulators. China still has a regulatory system, not a unified regulator. But the result, I think, of the attention that Xi Jinping has given to this issue has emboldened the regulators, and they've been moving pretty aggressively to reduce risk in the financial system over the last several quarters. And I just want to give you a number of indicators of that, starting with this very sharp decline in interbank lending. The regulators have taken a number of steps, and why did they do this? Well, a lot of the medium-sized and smaller banks have expanded their balance sheet by borrowing very, very heavily in the interbank market. Their interbank liabilities, in many, many cases, and indeed on average, their interbank liabilities are greater than their deposit liabilities. These banks borrow in the interbank market. They hand the money over to trust companies, asset management companies, security firms, which on-lend it to the final user. And the banks have engaged in the practice of recording these transactions as investment receivables or financial assets for sale. When they do that, they don't have to hold much capital against these assets, 25% risk weighting as opposed to 100% risk weighting on a conventional loan. Most of these financial assets for sale are actually disguised loans. So the regulatory response has really been twofold. First of all, there has been in place a regulation that banks interbank liabilities can't exceed a third of their total liabilities, but they've expanded the definition of interbank liabilities to include interbank CDs, which were presumably previously classified as bonds issued. Now they're going to be classified as interbank liabilities. So you can see the banks are adjusting to this new environment by dramatically reducing the level of transactions going on. So that's what what the People's Bank did. For its part, the bank regulator has issued regulations which largely reduced regulatory arbitrage by requiring a higher risk weighting on these investment receivables and financial assets for sale. So the incentive to carry out your business through these channels has declined. You can see these activities were growing 40, 50% or more for quite a few years, and we're now down to 10%, and I'm guessing that it will go even lower before we're through, because the new regulations, which were announced a few months ago, a couple of quarters ago, are coming into effect at the beginning of 2018. If you're not in compliance, then you're subject to a number of penalties. A further aspect of this is that the borrowing by non-bank financial institutions in the interbank market has declined even more rapidly. This is a big chunk of interbank activity, bank lending to non-bank financial institutions. The second quarter of this year was the first time ever that assets under management by non-bank financial institutions declined. I think this is positive for reducing financial risk, which stems in large part from these chains of intra-financial credit. Chains of activity involving non-bank financial institutions are particularly risky because these institutions don't have access to central bank funding. There are a couple of other indicators, I think, that are worth looking at when we're trying to assess the risk the risks that are building up in the financial system. This is a diagram that is showing us how much borrowing is going to the household sector versus how much borrowing is going to the non-financial corporate sector. And you can see that loans to households have picked up very rapidly in 2015 and 16, particularly in 2016. Over half of all new loans, renminbi loans, are going to households in 2015. In 2016. This increase in lending to households has been so rapid that the actual amount of lending going to the corporate sector in 2016 fell by over 20%. So the composition of lending is changing, and again, this reduces financial risk. The financial risk is greatest in the non-financial corporate sector, where leverage ratios are higher. It's much less in the household sector, where household debt relative to disposable income is about 75%. That compares to around 100% in the US today, 140% pre-global financial crisis. And a very large share of household debt is in the form of mortgages, and the average loan-to-value ratio is something like 25%. So I think as you change the composition of lending away from the corporate sector and more towards the household sector, it brings down the risk in the overall risk in the system. I'll give you one more indicator of the crackdown, and this is in the insurance sector. In the latter part of 2015, the chairman of the Insurance Regulatory Committee eliminated a cap that insurance companies could offer on investment products. This led to a massive, massive increase. You can see this is for Anbang. This is the high-profile company that bought the Waldorf Astoria. They were the most aggressive of the insurance companies in issuing these short-term universal life policies. I'll stop at this point. I'm going to do a survey. How many of you recently have bought a universal life policy with a maturity of 3 months? That's what they were selling at very high interest rates. So it was basically an investment product. And of course, they're using the money to buy the Waldorf Astoria on Park Avenue. Of course, that means they're incurring very substantial maturity and currency mismatch risks. The regulator began to crack down on this in the early part of 2017. The chairman of the insurance regulator was removed, placed under investigation, and hasn't been heard from since. The next month, Anbang was precluded from issuing any investment products, and you can see what happened. Their income from, the premium income from investment products basically collapsed by almost 100%, a 98% decline in their overall premium income as a result of being precluded from issuing these short-term products. Wu Xiaohui, who was the chairman of Anbang, was detained in June. He too has disappeared. Probably almost certainly will end up in jail. Anbang has faced a substantial liquidity crunch as a result, but the government has not come to their rescue, and they have sold off substantial holdings of their shares in the 4 major state-owned banks. If you look at the annual reports of these banks, Anbang was a top 10 shareholder in all 4 of the big state banks. Previously, by the end of the second half, the banks report, only one bank is reporting that Anbang is a top 10 shareholder. So they sold down a substantial portion of their portfolio in order to deal with the liquidity situation. I want to look at one more indicator in what the financial risks are. And in my view, the period of maximum financial risk was in 2015. If you look at this diagram, 2015 profits of state-owned enterprises fell by about 10%. There was a slight recovery in 2016, but profits in 2016 were less than they had been, as you can see from the vertical bars, less than they had been in 2013 or 14, but the amount of debt by state-owned companies had increased very substantially. But the Moody's and S&P downgrades came in 2017 when the profits, as you can see from the line, have been expanding. Profits are up 22% in the first 8 months. And for industrial companies, industrial state companies, the recovery has been much, much stronger. They have a 46% increase in profitability in the first 8 months of this year. So the downgrades may have been justified. I think they should have come in 2015 or early 2016, not in recent months. So my summary is not to say that there aren't risks. I think the rapid growth of credit does pose risks, but I think it's been acknowledged by the top political officials in China. The regulators have responded pretty vigorously. Interbank lending, particularly claims on non-bank financial institutions, are shrinking. The share of lending going to less leveraged households is rising, and to more leveraged corporates is falling. Major risks in the insurance sector are being addressed. Profitabilities of SOEs, which are the most highly leveraged companies in the system, is improving. It still is an open question, however, if growth slows down significantly as a result of slowing credit growth, will the authorities resume very rapid credit growth? I'm betting they won't, but virtually everybody in the financial industry is expecting credit growth to reaccelerate when growth slows down. Thank you.
Well, hi, it is a pleasure to be again here and talk a little bit about Latin America. Perhaps the title is a little bit negative because it's low growth, low potential, low everything. But it's recovering. Too low, but it's recovering. So this is what I will talk a bit about the perspective of Latin America and to finish with the discussion of macro policy in the region and some comments with the corruption cases and what's going on. So Latin American growth performance, we have a very bad this year. There has been a deceleration in most of the countries, with the exception of Argentina and Brazil that are coming out from recession. In the case of Brazil, coming out from a big recession. So they're growing fast. Argentina is the fastest growing among these are the 6 largest countries. I always exclude Venezuela because it distorts all the figures, and it's very difficult to talk about Venezuela and things. So what we see is next year will be much better everywhere. Chile, Colombia, Peru will be growing faster. Mexico will keep growing at about 2.5. It's a major puzzle for me. Whatever they do, they grow at 2.5. And they join NAFTA, they keep growing at 2.5. So it's kind of a quite interesting case. But The rest will see some recovery in Argentina, especially in Argentina and Brazil, and the rest of the countries growing a bit better. Now, this is the year 2022 is the last year, and then we have what happened during the crisis. The last year is what the IMF thinks is the growth potential. So we're talking that countries in Latin America, on average, these countries, in the long run, will be able to grow at 3%, according to current estimates of potential growth, which is relatively low to what we were used before the crisis, countries growing at 4 and 5%. But perhaps the most impressive things that this is going on all around the world, is what was predicted by the, I'm sorry, I forget that this is the other way around. What it was predicted before the crisis, or 5 years ago, to be long-term growth by the IMF. And this is the last line, and here I delete the rest. So the average growth for the long run, 5 years ago, this is like secular stagnation all around the world, was 4.5% for this group of countries. Now it's 3%. It's a decline. This is a 5 years ahead forecast. This is a decline of 1.5 percentage point for the whole region. For most countries, it's quite notable the case of Peru, that was extremely successful. I want just to make a comment. But this is going on not just in Latin America. If we do exactly the same exercise for the whole world, the IMF has estimated a decline in the world growth of 0.8, 80 basis points. In the case of advanced economies, it's about 1 percentage points. For all emerging markets, it's about 1.2%, and so Latin America is a little bit deeper, but it's not different to what's going on all around the world. The case of Peru is interesting because Peru has shown the best performance in the region in recent years, but it's to a large extent due to the expansion in the mining sector. Just to keep figures in general, Peru used to produce 1.2, the third producer, 1.2 million tons a year. Chile is the largest, 5.7, so it's a big difference. And now Peru will be in a period of 4 years to 2.7 million. So it's more than 100% growth in mining production in 4 years, because during the commodity price boom, they had a lot of investment and new mines that they were. So taking that into, leaving that aside, growth is much more similar, still a bit higher, but that contributes to increase roughly 1 percentage point growth in Peru in the last few years. So this is kind of to bear in mind. What's happened in the medium term and the long term? Latin America was extremely successful around the commodity price boom and then the recovery after the crisis. But then here we have the successful Asian largest 7 countries, and here we have the US and the world economy, and has moderated a lot of growth in the region. What's behind this? I would say kind of it's going on in all emerging markets too, is the lack of productivity growth. Productivity growth has been extremely low in all the region. Most of this catch up in recent years was more associated to strong investment, to a lot of investment also during the commodity price boom, and that also explains why the region has been moving very close to this dotted line, the dashed line, which is a growth of commodity exporting emerging markets. You see Chile, Mexico, Colombia, and Peru growing about the same rate. Of course, Brazil and Argentina, they have their big recessions before, but the growth has been synchronized and very close to what has been a growth in commodity exporter emerging markets. So this is roughly performance. Will grow low, Latin America will recover, but with a lower growth in the future compared to what we expected in the past. How is going on the adjustment? Part of the adjustment has been, of course, the depreciation of the currencies, which have been quite, especially starting in 2013. Currencies have depreciated significantly in the region. Now, competitiveness gains, as we can see from the real exchange rate at the right side panel, has not been that large, basically because all countries have depreciated together. So we have the case of Chile, Mexico, and Peru depreciating nominally about 30%, but the real exchange rate had just depreciated about 10%. Here going up, I have to clarify, is a depreciation. So we have two periods, a period of rapid depreciation and very massive, and then we have had more recently appreciation of the currencies, with the exception, of course, of Mexico, that has been much more related to developments in the US. But looking from 3-4 years ago, the gains in competitiveness in the region, most of the ones that happened during this period, have vanished. The current account have adjusted in most countries. Here we can see Argentina is the only exception because it has been growing. It has one of the strongest currencies too. They still are dealing a lot with stabilization. They have inflation running above their target of 17% for this year. So it's kind of still the country that's suffering from high inflation, strong currency, but still it's quite limited, the current account, at about 3% of GDP. Most of the rest of the countries, especially Colombia, that a couple of years ago there was a lot of concerns for Colombia running 7% current account deficit, has also been declining, and they have come to more normal levels. Most of it has been the result of the deceleration and the import compression. And just recently, we've seen some of these countries, and except with the case of Peru with copper, we have seen some increase in exports, and perhaps a result of the depreciation of previous years. So let me just now move to what's going on in the fiscal side. And the space for fiscal policy is quite limited. We see in most countries, I don't want to go into details, a persistent deterioration of the fiscal balance since we started here in 2010, after coming out of the Great Recession, strong growth, but we see especially Argentina, Brazil, Chile, Colombia. Mexico has done some fiscal adjustment, and quite important in the last few years. They have increased fiscal revenues by about 4% of GDP, and the result of broadening a lot of the tax base, so not increasing too much taxes, but they have increased about 25 to 30% the number of people paying taxes and corporations, so that has been quite important. But the rest of the countries, Peru, this is so to the deceleration and commodities and the declining commodity prices. This has, of course, deteriorated fiscal figures. If we take into account the year 2009, that there was a strong fiscal expansion in the region, so the deficit still in much countries is much larger. So this is the first reason why it's very difficult to find in the region some serious fiscal space. The case of Brazil, that has a large debt, and I'll show you in a minute, but has a primary surplus of 2% of GDP. It has a primary deficit of 2% of GDP, at about 9% the total fiscal deficit. And according to the sustainability estimate of the fund, they need to turn the deficit to primary deficit to 2% surplus in order to be sustainable with the current levels of public debt. The current levels of public debt, Brazil is a country, this is 2014, and expected for this year. In all countries, of course, have increased. In the most serious cases, Brazil, with debts close to 80% of GDP, much higher than the ones of the Reinhard-Rogoff limits of 40% for emerging markets. But of course, this is in a world of much lower interest rate than what we had 20 years ago, when there was a lot of default. Net public debt is somewhat lower, and especially in the case of Brazil, because they have a lot of reserves and they hold a lot of public securities. This is for a lot of institutional regulations in Brazil. So it declines. It doesn't decline a lot, but to levels close to 50% of GDP. So overall, there is not that much space for fiscal expansion. Most countries have to do some form of fiscal consolidation in next years, and some help has been coming from monetary policy in the region. What we see is that monetary policy started loosening in last year, in 2016, as inflation was coming down. with the exception of Mexico, that is a special case. I wrote also blogs a year ago about Mexico raising rates too early because they start raising rates with the US, so they basically move together and inflation start picking up much later, but I won't refer that much to Mexico, but the rest of the countries have been cutting rates. Have been cutting rates as inflation has been also coming down. Now, what's behind all of this is an economies that have been decelerating, but that have had, as I showed you before, sharp depreciation of their currencies. This fits into inflation, and then when after some time this is over and inflation start coming down. In a way, and then we see then that there is an interest rate cut. This interest rate cut was much correlated with what's going on with inflation, so we may think that there has been a lot of a correlation of inflation with interest rate, but the cuts came much later than inflation started declining. In the case of Brazil and Colombia, inflation started declining seriously, start declining after the decline, 6 months after the decline, and this is the case of the most serious inflation hikes in the region, and they start cutting 6 months later. In the case of Chile, a year later, inflation was coming down. In the case of Peru, that was about here, and in case of Peru, was about 18 months later. Now, monetary policy has come now, has been cutting rates. Most likely, in the case of Colombia, Peru, and Brazil, there will be further cut. In Chile, it's very unlikely, and Mexico, and in the case of Argentina, that doesn't fit in the graph, they may cut, but they will see what's going on with inflation. Why monetary policy has been a little bit ahead of inflation development, and why monetary policy has not been forward-looking enough? We would expect that moves before inflation start, it hikes before inflation start raising, and it cuts before inflation start coming down. I think that there is still in the region, and it has come, especially with the large depreciation, a lot of fear of floating. We see how inflation went up in most of these countries. What has been impressed, and I think that this is how correlated and how contemporaneous has been the correlation between inflation and depreciation. We used to think, and central bankers to say, that you have to be very careful because the second round effect, and when currencies depreciate, you may have a very long period of pass-through from the exchange rate to inflation. In this case, what we can see in the case of Brazil, Chile, and Colombia is that inflation went up almost instantly, or very close to when the exchange rate depreciated. And when this stopped, the exchange rate the inflation start coming down. So there is from a policy point of view, inflation within the horizon, the exchange rate has much less effect on medium-term inflation, current development on the exchange rate. The only very special case, and I hope next year I will show you how this finishes, is Mexico. Inflation going up, and this is much after the exchange rate depreciated. So it seems that that's the case with much more lags, and perhaps we should start seeing soon a decline in inflation. This may be also the result of expectations and lack of credibility. Still too soon to say what's going on. So let me just close with this overview of Latin America, saying that after I said monetary policy, fiscal policy, growth, low growth in the future, also Latin America has a lot of political turmoil. And the only way to summarize is what's going on with president's popularity. And I don't have, and I was trying to kind of show the story, and it is quite common that the president starts government, and after a year, there is some decline in popularity. But except for the case of Argentina, in which popularity has remained relatively stable, and after a year and a half, almost 2 years since Macri came to power, we see, well, Brazil is still low, and still low, with a lot of problems with the president, you know, and all the discussion about corruption cases in Congress. In the case of Chile, with a lot of discussion in policy and reforms. This is, you say this could be normal, but for the Chilean case, it's not normal. In Chile, presidents tend to be popular even after they leave. This is kind of newer in the last two periods. And Colombia, despite peace and everything, we also have had a sharp decline in Mexico and Peru. Peru, which is the most recent election, just a year, a little bit more than a year ago, a government without a majority in Congress, losing ministers every quarter, and with political crisis because of not having majority in Congress and enough agreement. I think that is denting growth, and it's also denting and limiting the possibilities to do reforms and to spur productivity growth. Thanks.
Thank you very much, Jose. If I could ask Jose, Nick, and Dave to come up. Not merely to fill time, I just want to say a moment of thanks to David J. Stockton. As we mentioned, as Dave mentioned, this is the 10th one of these he's done. I think he's done 10 out of the last 11. This was obviously a very relaxing shift for him from running the FOMC process at the Federal Reserve Board, but it's still a big task and one which we have benefited enormously from his participation. 5 years ago, when I succeeded Fred Bergston and became president, I had the fortune to notice that was exactly when Dave was retiring from the Fed, and I asked him to come aboard as a senior fellow at that time, and he, in his usual way, said, "Oh, sounds like fun. Maybe I'll do that." And it's been wonderful having him not just leading this process, and which has a lot of background of consulting with all the fellows and getting input, but being a colleague and a resource for us on forecasting on the US, on fiscal policy, as well as obviously monetary policy. So I say this not because anything terrible is happening, but Dave has understandably given notice that after 11 of these, it's time to move on. He will continue to be affiliated with the Institute, but we are releasing him from this obligation with our deep thanks. I am delighted to announce that Professor Karen Dinan, who's with us today, professor at Harvard University and non-resident senior fellow here at the Peterson Institute, is going to take over from Dave. You've seen her speak at our last one of these, semi-annual, talking about fiscal policy in the US. Without getting too sentimental about it, Karen and Dave have sort of moved as a pair through various jobs through the years. Karen, I think's first job in Washington was as Dave's research assistant. And so in addition to that, of course, Karen has had her own, by saying that, her own rising star and distinguished career at the Federal Reserve, at the White House, as Assistant Secretary for Economic Policy and Chief Economist of the US Treasury in the last administration. And so we will be going forward under Karen's leadership with this semi-annual process, which will be wonderful, but it also provides the opportunity to say, thank you, Dave, for all that you've done for us in the last 5 years. Thank you very much. So having said that, very heartfelt, I know you all want to get to the bottom line. So let me open this up for questions from our distinguished audience. I ask that our fellows allow our guests to ask the first couple questions before challenging their colleagues. We have a roving microphone up front with Jessica. We have a standing mic at back. Please indicate, either move to the mic or indicate if you'd like to speak. And if none of you do, oh, please, then we'll have to resort to internal people.
Dave, what would it take for the United States to grow at 3% for a year or longer?
Before you answer that, Dave, I'm sorry, sir, could you just for the record identify yourself?
I'm Larry Krause, University of California, San Diego.
Thank you, Dave.
So for a year, you could probably grow 3%. Relative to my forecast, that will push the unemployment rate down into the mid to low threes. And that could take just a substantial fiscal stimulus could produce that. The notion that you could get sustained growth at 3% for any length of time either is going to take some kind of profound change in the growth of productivity, which economists don't know how to really manipulate, or a change in immigration policy that might allow much more generous immigration in the United States, boosting labor force growth significantly. None of that seems in prospect to me. So I guess I would say, yes, it certainly is possible. Fiscal stimulus, I can't see monetary policy at this point generating by itself 3% growth. It could accommodate that fiscal stimulus in some sense, but even then you get some market reaction that would be offsetting some of it. So I think it's not out of the question, but pretty difficult to achieve.
Thank you. Next question or comment? Okay, we end up with Fred Bergston, please.
What a fate. Dave, I was struck by your comparison between your baseline forecast and your forecast in the absence of the fiscal stimulus that you assumed. It struck me that the gains that you saw from the fiscal stimulus, 0.2% a year, compared with very small costs, maybe a slight uptick in inflation and a little bit higher interest rates. Does that mean you support the fiscal stimulus package that's being put forward? And if so, I would think that's a significant outcome.
So I'd say no, I wouldn't support that fiscal stimulus at this point or any significant tax cuts. In fact, because what I showed in that alternative simulation was that without the fiscal stimulus, that's a pretty, to my mind, that is an outcome that looks less risky. It has an unemployment rate that is still probably a little bit below its equilibrium natural rate, full employment, but not much. Has an inflation rate that levels out at about 2%. That feels like just about as good as we can do. Now, if you're asking, the costs of that fiscal stimulus are not really going to be borne in the near term. So you're right. So if we ended up with 3.9% that I have in the baseline with the fiscal stimulus and a 2.1% inflation, that's no big deal. What is a big deal is that the kind of fiscal program that I am talking about here, 1.2 trillion in tax reductions and another 400 billion in spending increases over 10 years, pushes the federal debt to GDP ratio close to 100% by the end of 10 years. And you are going to see both a higher path of interest rates, some effect eventually, not in the near term again, in terms of capital accumulation. And I think we're just making the whole fiscal position that much more difficult and reducing fiscal space to deal with over the next 10 years. Are we going to get hit with something that might cause a cyclical downturn? I would think the probability is reasonably high. And if we are exhausting our fiscal space when we're at full employment, we're leaving very little space to do anything when we really need to. So I guess I would feel like more comfortable if we just sat tight at this point.
Thank you, Fred, for prompting that really excellent exchange. I just want to ask Nick something in a sense, partly because I think it's important and partly to give Nick a chance to show that he's not always Mr. Panda Sunshine. You, in past conversations, both internally and some things you've presented externally in the last 6 months, have mentioned, of course, the issues of financial stability, but also have mentioned that some of the allocation of credit in China over the last few years has been more towards the state-owned enterprise sector and less towards the private sector. And this is having a negative effect on productivity growth, if I'm characterizing you correctly. So I just wondered if first, given your look at the latest data, if you see that trend continuing, how important is that from a growth perspective, not so much a stability perspective? And while I know you don't want to get into tea leaves, to use a bad expression, do you foresee the Party Congress perhaps pushing further down this line of state-owned enterprises, given some other statements President Xi has made?
No, I think you put your finger on the biggest problem, and that is that the share of credit going to state companies has gone up, and the returns of those companies are extremely low. something in the neighborhood of 2 to 2.5%, about a fourth of the returns of private companies. Their access to credit has improved. They're absorbing more and more of credit from banks. And so I think there is a tremendous misallocation of resources, which is dragging down economic growth. So it's not so much the headline credit to GDP, it's kind of delving beneath that and noticing, for example, in diagrams I've used before, which are still true, the leverage ratio, that is credit to net worth, credit to equity for state companies is going up very sharply, and for private companies, it's going down. In other words, private companies are using the money more efficiently, they're paying down their debt, and state companies are borrowing. I think there's a very substantial amount of lending to state companies that's simply rolling over old debt because they're not generating enough profits to service their existing debt. So I think that's the big problem, not the headline number.
Thank you very much, Nick. Yes, please, in back.
Larry Wood, RTHK. Dave, I'd like to ask you this. A year ago, you said that it was a rudderless global economy and we were stuck in the slow lane. What happened? If anything, because that was before the election, all of the experts would have said, did say, if Trump was elected, things would get even worse. And yet we're in the midst of a big equity boom globally. So what's your explanation as to why this turnaround?
So that's a good question. In terms of the pickup, I'd say certainly in the United States, the effect of President Trump, at least in the short run, has been to lift business optimism and lead to a sense both in terms of the expectation of lower taxes and less regulation to a bump up in investment spending. You know, globally, I do think in some sense the inflation environment has been helpful in the sense of heading off expectations that there was going to be any immediate sharp shift in monetary policy towards restraint. And I think, you know, expectations, everybody's expecting, certainly the Fed is on this path of normalization. People are expecting the ECB to begin to taper, but this whole process looks like it's going to be slow and that there's more sense that one can accommodate more growth going ahead, and that won't be choked off by policy. Some of it, as I said, I guess this is another way of saying I don't know, but to say animal spirits, if you look at survey measures, it is pretty remarkable the extent to which a broad range across countries of surveys of business people, purchasing managers in particular, seem to have improved significantly. And of course, these things are all endogenous in the sense that we're benefiting from the pickup in the global economy. Many other countries are benefiting from the pickup here. It's just a sense in which a synchronous expansion begins to take hold. And one shouldn't overstate. So, I mean, I think things have improved, but this is still not an economy, a global economy that is booming. It's just it's an economy that is now feeling like a global economy, feeling like it's repairing itself and improving slowly.
Okay, I have Bill Klein.
David, I wonder if you could give us your take on how we should think about the prospective impact of corporate tax cuts on investment. As I look at the data, when you cut the corporate rate from 46% to 34% in the late 80s, you didn't see a huge surge in non-residential investment. On the contrary, it was sort of stagnated. So, but you scratch a typical economist of a certain persuasion, and you will get statements like, well, there's a huge literature on how there's this huge response of investment. So what's the right way to think about this?
So I think the literature is pretty mixed on the effects of corporate changes in the corporate marginal income tax rates on investment spending. There's some firm level data that suggests the effects are relatively small, some time series data that suggests larger effects. You know, I didn't do anything fancy in terms of incorporating this in the forecast. I just jiggered the cost of capital term in the Federal Reserve's large-scale macroeconometric model. Lower tax rate lowers the cost of capital and spurs some investment spending. You know, to be perfectly honest, in terms of investment, it's the case that it's hard to find strong evidence that interest rates matter for investment spending. And that is, in some sense, a main channel that most of these models incorporate. So I think there's enormous uncertainty about what the effects would be. I felt comfortable, in some sense, assuming that a lower cost of capital would spur some additional investment spending, but I surely wouldn't ascribe to a view that those effects are large. And I think it doesn't strike me as a reasonably balanced assumption to say they'd be zero either. So I think some modest step up of the growth rate of investment spending seems reasonable.
Very good. Jeff Schott.
I was struck by Jose's forecast for Mexico, and it seemed quite sanguine, not accounting for any shocks, whether natural or man-made. We've already seen several natural shocks, and we could see a man-made shock if something happens to NAFTA. Is that been accounted for in your forecast, or what would happen if it wasn't to your forecast for Mexico?
With natural disasters, first, it doesn't have on the net a very big impact because we may see some disruption for this year of about 0.1% of GDP as result of all disruptions in production. But then we will have some reconstruction expenditure, and that should be good for growth. Now, the baseline is basically no major NAFTA disruptions. Now, I don't know what means NAFTA disruption after I said that they joined NAFTA and nothing happened to. So I'm quite skeptical about what's there. That could be some strong readjustment because of the structure of and accommodation of Mexico to NAFTA. But I'm quite skeptical about the very strong long-term effects.
What I should just interject, and I'm glad I had a feeling Jeff was going to ask something like that of Jose, and I'm glad you did, is of course we, like much of the economics profession, are sort of schizophrenic between our people who do trade and our people who do macro. For whom our people who do trade, these effects on their models are usually very large. For our people who do macro, these effects always wash out. And I personally, despite being a macro person, think it's more like the trade effects. But anyway, just to say, our colleagues Sherman Robinson and Marcus Noland, among others, are doing modeling, as they did a year ago, on issues of trade shocks to the U.S., trade shocks to Mexico, and we'll be releasing more on that in due course. Please, Monica DeBola.
So just one, Monica DeBola here from the Institute. Just one very quick question for Jose. So a number of the countries that we've looked at in your presentation are going to have presidential elections next year, and all of them look to be pretty contentious, and there's no clear sort of scenario to be drawn from those. So my question to you is, do you see any significant downside effects on the growth projections that you have for 2018 coming out of the electoral processes in these countries? Thanks.
Yeah, that's a good question, and there is a lot of uncertainty, and I think that there is another shock that we know very little, and it's the likelihood of AMLO winning in Mexico. I think that could be, and we don't know. Now, at the end of the day, I think that Brazil is, we don't know what will happen. Macri is the only, and in Chile there is more certainty. Colombia, I wouldn't say there is a derailment. In the case of Peru, a president that has been quite effective, arriving, is the only one that's not being prosecuted. The last three presidents, Garcia, Humala.
Not something the U.S. might be able to say, but anyway.
It's pretty bad. So it's...
Yeah. Don't say that before he gets prosecuted.
So I don't know how much, and we have had also in the region at some point very strong changes in government. I was the first Lula government. I think that the second one could be pretty bad, but I really don't know. I think the region in general is facing a threat of populism. Right wing, left wing, there is no distinction. And populism will be a new form of populism. It won't be the 30 years ago populism that wants to expropriate all and close the economy, but it won't be good news for growth, and perhaps it's underlying also the low growth perspective for the next few years.
Thank you very much, Jose. I'm going to close it there with a brief advertisement, a couple brief advertisements as ever. Picking up on Jose's very important point about the issues of populism in Latin America, our colleagues Monica and Jeremy Zettelmeyer are starting a new project on economic nationalism, comparing Latin America, Europe, US, and the economic aspects of it. And some of you may have seen, we tweeted out today a new statement by Jeremy. He gave us a talk on this recently in Latin America. Secondly, this is, of course, for those of you who are real hardcore PIAE fans, this is the start of Macro Week. Our Macro Week always runs the week before the IMF World Bank meetings in the fall and the spring. And we start with our version of the WEO, the Global Economic Prospects. Next week, we will be featuring on Wednesday in the morning, Catherine Mann, Chief Economist of the OECD, another notable PIAE alumna, talking about the OECD's work on trade and growth and supply chains with comments from our senior fellow, Chad Bown. In the afternoon, we have the pleasure to host Klaus Regling, the founding head of the European Stability Mechanism, an institution that obviously has some potential upside and change in mission as a result of recent discussions in Europe. And Klaus will be celebrating the ESM's 5th anniversary and talking about its future with myself and the aforementioned Jeremy Zettelmeyer. And then, of course, next Thursday and Friday, I'm afraid if you haven't booked your ticket by now, you'll have to watch online, but it'll be worth it. Our version of the Rethinking Macroeconomic Policy Conference led by Olivier Blanchard and Larry Summers and featuring opening remarks on monetary policy by Ben Bernanke, Mario Draghi, and Lael Brainerd. So please mark your calendars for the Festival of Macroeconomic Week here at the Institute. We will revert to our normal NAFTA programming shortly thereafter. And mark your calendar for 6 months from now, where under Karen Dinan's baton, we will be having the next of our global economic perspectives. Thank you, Jose. Thank you, Nick, and especially thank you, Dave.